in 20 years, we only had 3 down months out of all those months. And those down months were less than 1%. So it basically just printed money every month. And it made just under 20% annualized during that time.
Hello, boys and girls, ladies and germs. This is Tim Ferriss, and welcome to another episode of The Tim Ferriss Show. I'm going to keep my intro short because I want to jump straight into the conversation. My guest today is Edward O. Thorp. He is the author of the bestseller Beat the Dealer, which transformed the game of blackjack. His subsequent book, Beat the Market, co-authored with Sheen T. Kassouf, influenced securities markets around the globe. He is also the author of A Man for All Markets, subtitle From Las Vegas to Wall Street, How I Beat the Dealer and the Market. Thorp was one of the world's best blackjack players and investors, and his hedge funds were profitable every year for 29 years. He lives in Newport Beach, California, and his website is edwardothorp.com. Ed, it is so nice to see you, and thank you for making the time.
I was born in Chicago during the reign of Herbert Hoover, president number 31. So I've seen 16 presidents. I moved out to California with my parents during World War II. And basically grew up in California, went through junior high school and high school out here, and then went to UC Berkeley and UCLA, and I got a bachelor's degree and a master's degree in physics. And then in the middle of my PhD for physics, I realized I needed more math, so I started taking it, and then I saw I could graduate more rapidly in mathematics, so I got my PhD in math instead. And then I went on to teach at UCLA, MIT, New Mexico State University, and finally University of California, Irvine.
Now, how did gambling or interest in those types of applications of physics or mathematics enter the picture for you?
Well, I'm a curious person, and you could say that it happened purely by chance. When I was teaching at UCLA, I got interested in beating blackjack. Somebody told me about an article that would let me play almost even. So one Christmas vacation, my wife and I went out. It was actually Christmas vacation of 1958, when just after I got my PhD, we went out to Las Vegas, and I never gambled because I knew it was a loser for most people, and the odds were against you. But I bet $10, and I played for about 40 minutes, and I had an interesting experience. The first 20 minutes, I had a little card telling me what to do, and people thought I was a fool who knew nothing about the game, and they were right that I knew nothing about the game, but the card made me much smarter than the other players. And so I made some remarkable plays that attracted their attention. And then they all hovered around. They wanted to see how I was making these plays. In one of them, I got a 7-card 21, which is very rare, and in most places paid a bonus. They didn't pay bonus in this particular place, but they thought I was trying for that, and I somehow managed to produce it. So I realized they didn't know much about the game, really. So once I had some money from both gambling and book royalties, I wanted to figure out what to do with it. And so investing made good sense to me. I would put some capital aside and let it grow. I started out by making a lot of foolish beginner mistakes, which cost me. And then I decided to sit down and really figure this thing out. And so I began to study investing in my spare time. So I spent the summer of 1964, which was, I guess, the third year I was at New Mexico State, just reading all summer in a big bookstore in Beverly Hills, Martindale's, reading all the investment books and newspapers they had. And then I started again in the summer of 65, reading whatever I could find. And I happened to get a little book on warrants, common stock purchase warrants, which were the forerunner to what people call call options now. And when I saw that, a light came on, and I realized that I could mathematicize this, and I could figure out how to value these things. And if I did that, I'd probably be ahead of the crowd who didn't know how to do these things. and so I'd probably have an edge. And so I began to do what are called warrant hedges. And basically you buy a cheap warrant and you short common stock against it. That's one way. Or you buy an overpriced warrant and you short it. I said buy. You short an overpriced warrant and you buy the common stock against it to hedge the risk because they tend to move together. And when, in the case of the overpriced warrant, as it collapses toward zero or toward its conversion value, you capture an excess return. And what I found was that you could make a steady 25% a year with practically no risk doing this. So I was doing it for myself, and then word spread around UCI campus, and people wanted to sign up. So I signed up the dean of the graduate division, and I also signed up the secretary to the chancellor, and some people in the math department and so forth. So I was managing a whole collection of little accounts for people, and they were making 25% a year, and they kept telling everybody about it. And the dean of the graduate division happened to be an investor also with a fellow named Warren Buffett. And Warren Buffett was, at that point, shutting down his partnership because everything was overpriced back in 1968. Prices were crazy. And the dean of the graduate division wanted to know where to move his money to. So he introduced me to Warren Buffett to kind of check me out to see if I might be a good place to put it. And so Warren and I got along fine, and apparently I passed the test because the dean gave me his money to invest. I got the idea of forming a hedge fund from Warren Buffett, who was just closing down his hedge fund. And so I went into business managing accounts and then merged the accounts into the hedge fund and started this hedge fund or private limited partnership. And that ran for about 20 years and used ideas that I kept generating, mathematical finance ideas, to keep staying ahead of other investors and making excess returns. And in 20 years, we only had 3 down months out of all those months. And those down months were less than 1%. So it basically just printed money every month. And it made just under 20% annualized during that time. So here was I'm very risk averse, as you'll find as we continue to talk. And so this thing ran with extremely low risk, but yet had a very high return. So that was my entree into investing.
That's one hell of an entree. 20 to 25%. Let me hop in for a moment here to ask a few questions about your meeting, or at least one, with Warren Buffett. Why in that meeting did you come away saying you thought he would end up being the richest man in the world? What did you see or hear or observe in that meeting that led you to that?
I saw that he was compounding at a high rate of return, that he'd been doing it for a long time, that he was very, very smart, and that he really knew a tremendous amount about companies. So he was a good evaluator of companies. So he had this, and he demonstrated a very large edge already. He'd been running his partnerships from 1956 to 1968 and had about a 30% before fee annualized return rate. And I was sorry that he was going out of business and that things looked so bleak from the standpoint of stock pricing to him at that time. Interesting follow-up to that story. What Warren Buffett did at that point was he decided to make a poor textile company in, I forget where it was, somewhere in New England, called Berkshire Hathaway. He decided to make that his own little mutual fund, private mutual fund. And he bought up as many shares as he could. And he didn't particularly encourage his exiting partners to take shares in that company because he wanted them himself. They didn't have a choice. They could take cash or they could take shares in Berkshire. And not knowing what to do, many of them just took cash and exited. Some of them took Berkshire, though. Berkshire, I think, they would have gotten it at something like $12 a share in 1964. Now it's a little under $500,000 a share. So
Oops.
the Berkshire story is kind of interesting. I knew how smart he was, and I said the way he's compounding, he's going to be, in my opinion, the richest man in the world in a while. It'll just take time. And I lost track of him. I figured he was just working for his own account, and there was no opportunity for an investor. And that was largely the case. But then back up in 1982, I happened to see an article about Berkshire Hathaway, and I saw that he was running it. And then I decided to take a look, and I said, oh, it's gone from 12 to 982. So is the opportunity gone? Many people who owned it had sold on the way up, taking their enormous profit of a multiple of 5 or 10 or 15. And I said, I know what he's doing. I know this man. I know what he's going to do. I'm buying at 982, even though I missed out the move from 12 to 982. And of course, buying at 982 turned out to be a good move. The first thing I would tell them is the answer is really easy for almost everybody, but you're not going to believe me until you work it through yourself and understand it. And I'll tell you the answer to start with, and then I'll try to convince you that it's the right answer. So I'll just tell you the answer to start with. The answer is, if you're a long-term investor, you should just buy and hold equities. And the best place to have bought and hold equities has been the U.S. for the last couple of hundred years overall. Equities here have compounded at about 10 or 10.5% for 200 years. The data for the first 100 years is not as good as the data for the last 100, but the data for the last 100 is quite good and very well documented. How does that do against everybody else? Well, you can prove by logical and mathematical arguments, and I won't go into all the details here. Some of it's in my book. It's also in other places. You can prove that if a person simply buys the index and holds it, he will outperform most of all the other players. And he will simply, the people who buy and hold the index will beat the whole collection of people who don't do that. They do way better on average. The ones who don't do that pay trading costs. They have more volatility from diversification generally, from lack of diversification. And they often pay investment advisors and all this, and they also pay taxes when they trade. So the upshot is that you might make 10.5% if you don't pay all these people. You might make 8 or 7 or 6% if you pay the crowd of people waiting to, quote, help you, unquote. If you really are interested in investing, it's worth educating yourself and trying to do it because you will learn a lot about investing. You might actually find a way to win, and you'll learn about how the world works and a lot about life too. The things you learn from what seems like a narrow specialized field generalize very widely to all kinds of things if you're the kind of person who can take a lesson in one part of life and transport it to another part of life.
What are some of those transferable lessons in your mind?
Well, let's take risk as a good example. You learn about investment risk and how you want to avoid very great risks or minimize them. If you take that, because great investment risks can take you out of the game altogether. So you might have a thing where you multiply your money by 10 times, but you might also lose it all. Some things that are highly volatile, like buying cryptocurrency, are in this category where you may have the chance of a very large gain, but also the chance of a very large loss. And if you lose most of your capital, it's very hard to climb back out. For instance, if you lose 90% of your capital, you've got to multiply what's left by 10 in order to get back to even, which means you've got to make 900% to offset that 90% loss. That's not going to be easy to do. It takes a long time. So you want to avoid really bad outcomes. In any case, I would say that if you're looking at 15 or 20 years or more, maybe you have a dynasty trust or something like that, or you have descendants, and you yourself expect to live 15 or 20 years or more, the best investment, I think, is to buy almost entirely equities and hold it. You might want to have a little cash around, but I think Buffett recommends 90% index and 10% bonds or short-term, intermediate-term bonds for cash. That does just about as well as 100% equities. I just put it all in equities because I have enough so I don't have to worry about fluctuations up and down. If you have a shorter time horizon, you may want to do things differently. And it depends on how much you're going to need and how much you have. A lot of people are what I call scared rabbits. And when the market goes up, they get confident, they start buying. And then it drops, and they get really scared at the bottom, and they sell out. And then it goes back up, and they buy again. And it drops, and they get really scared at the bottom, and they go back out again. So they seem to have the worst of it all the time.
Doesn't feel good to go through life as a scared rabbit. And it certainly hurts your financial standing.
That's where thinking for yourself comes in.
Yeah.
You won't hold fast to something unless you understand it yourself. There's an old saying, give a person a fish and they eat for a day. Teach a person to fish and they eat for a lifetime. Mm-hmm. And there's a similar thing for thinking. If you give somebody advice about a problem, they might solve that one problem. If you teach them how to think about problems, they can solve problems for the rest of their life. And so that's the way to go. And also, if you give them advice and they don't understand what the advice is or how to think about it, there's a good chance they won't take their advice. Back in 1991, I was invited to review the portfolio of McKinsey & Company back in New York. And so they had a profit sharing and a pension plan. And I came and I looked at all the things they had, and the things they had were really quite good. But there was one very strange investment they had. It printed out 1 or 2% a month every month. They've been doing it for years. They had a record going back into the late 60s, supposedly. And I said, how do they do this? And they said, well, we don't know exactly. They tell us that they won't explain what their method is, but we can show you our accounts. So I looked at their accounts, and I saw that this account bought stock, and it put option positions on called collars. They had a put option a little below the stock price, and they bought a call option a little bit above, and the two things paid for themselves. It was self-financing. So they didn't have, apparently, a whole lot of risk. But I could show that in a down market, they would lose in a down month. In an up month, they would win. But they won every month. And the reason they won every month was because a mysterious trade was put on involving S&P index options. And it was always in the right direction. So if they were going to lose, it would be a winner. And if they were going to win, it would be a loser. So I said, this is not possible. I said, I want to go over and look at this place. So they called the person in charge, who happened to be at that time Peter Madoff, the brother of Bernie Madoff. Bernie was off in Europe raising money. This was 1991, mind you. And so when Peter Madoff heard I was coming, he said, no, I won't let him in the front door. So I held my nose and I said, I want to take a better look at all this. So I looked at all their trades, and I saw that half the trades never happened when I researched them. That is, there was no trades occurred on any exchange at the prices they were making them at for these options. Another quarter of the trades had so much volume that the volume couldn't have happened because there wasn't that much volume on the exchanges where they traded. The last quarter of the trades, which consisted of 40, there were 160 to start with, the last quarter of the trades didn't happen anywhere There was no explanation. So I said, okay, let's look at some of the trades that actually could have happened. So I went to a vice president of Bear Stearns, rest in peace, and said, we do a lot of business together. I'd like to ask you a special favor, which you might or might not be able to grant. I'm going to give you 10 options trades. I'd like to know who was on the other side of these trades. In particular, was Madoff and Company on the other side of any of them. So they researched the trades and they came back and said, no, can't find any trace of any Madoff and Company. So I said to McKinsey, this is a fraud.
What mental models do you find helpful, or would you teach in that class that I mentioned earlier? And you can really approach it in any way that you think is sensible. But how should people think about mental shortcuts or mental models? And are there any that come to mind that you think are particularly valuable?
I'll tell you about a few, and I'll tell you where to get more.
Perfect.
Let's take a notion that economists call by their priestly name externalities. Have you heard of that term?
I have heard the term.
Okay, good. Most people have not, as it turns out. So you're way ahead already.
Well, we'll see where we go.
An externality, simplistically, is a consequence that's of somebody's action that's generally not intended, and it's usually bad, but it's sometimes good. And I'll give you examples of each of varying sizes. Here's a bad one that happened to me actually last week. I go out to get in my car and I find out that the tire's flat. I look and I see a sheet metal screw in the sidewall, which means that this tire is going to have to be replaced. So I end up taking care of the problem. Where did the problem come from? Most likely, I think, down the road from me, there's been a lot of construction going on. I've noticed as I go for walks that pieces of metal are often lying in the road, sheet metal screws, nails, other things that aren't good for tires. I pick them up when I happen to walk by, but I don't get them all, and the workers are carelessly depositing more. Not very many, but it only takes one to give me a flat. So this is an unintended bad consequence of the work going on there. Who benefits? Well, the homeowner does, because he doesn't have to police his guys to clean up carefully and sweep the streets afterwards. He doesn't have to spend another $5 a day on sweeping labor to make sure that none of these things are there. But it cost me $500 for a new tire. Unfortunately, it's a Tesla Plaid with a 10.5-inch wide Michelin tire, so the tires are not cheap. So this is an unintended bad consequence for me that saves a very small amount for the guy who's doing the construction a few doors down. So there are a whole collection of these things that are out there that are very valuable for thinking purposes. One collection is there's a 50 item collection that came out under INC period on the internet from Elon Musk, and it's quite good. There's also Charlie Munger's book.
Poor Charlie's Almanac.
Yeah.
Is there anyone who comes to mind for you outside of Buffett?
There are people in the hedge fund world who have done remarkable jobs at various times, but they're not accessible to your listeners or to most people. For example, let's take Jim Simons of Renaissance.
Right.
Renaissance Partners is basically a private operation at this point, but it's been extraordinarily successful. It uses PhDs in computers and math and code breaking and so forth, and it has, from around 1989 or 90 on, been spectacular in its performance. Probably the best risk-adjusted record in the world from that time forward.
And for people who want to read more about Jim Simons, there's a book called The Man Who Solved the Market. But what was it at the time about Ken Griffin and Citadel that made it pass muster for you?
They were going to follow the exact plan that I was following when I shut down Princeton Newport. So that was good.
Got it.
And I knew Frank, and he was smart and capable. And Ken seemed very smart and capable and energetic. So they were doing what I would be doing had I stayed in business. The way I got into the investment world, I was an academic, and I was curious, and I found things interesting. And I wasn't really in there to get rich. I was in there to deal with interesting math problems that kept coming up. Blackjack, roulette was a math/physics problem. Investing was, for me, lots and lots of math. So I enjoyed that. So I just do things I like, and I don't worry about money. As my former sister-in-law once said, "Do what you love, and the money will follow." She wrote a book with that title, and I said, that's right. I'll tell you one story that you probably read in my book. It's about Joseph Heller and Kurt Vonnegut.
Yes, please.
Joseph Heller wrote his famous book, Catch 22, of which they made a movie way back, maybe 50 years ago. I'm not sure exactly when, but it was very well-known and famous at the time. And Kurt Vonnegut is well-known, too, for a variety of books. And Joseph Heller died, I'm not sure when, maybe early 2000s, and Kurt Vonnegut was writing in the New Yorker about him, and he said, Joseph Heller and I were at a hedge fund mogul's house. I'm not sure if it was a hedge fund mogul, but somebody very, very rich in New York. And I said to Joseph Heller, you've made a lot of money out of Catch 22. This guy makes as much money in a day as you're ever going to make. He's got penthouses and yachts and jets and villas and models falling off his arm and so on. And Joseph Heller looked back and said, I have something he'll never have. Kurt Vonnegut was puzzled. He said, what's that? Heller said, I have enough. And that's something that people who chase money to the end don't figure out, that you can have enough, and it's better than not having enough.